What's up, traders? What's up, tycoons? Super excited for today's video. There's a lot of bad information out there about the yield curves, about the Fed funds rate, and what happens with yields, as well as the stock market. So today's video is going to be a really great one, and it's going to show you guys using data, historical data, when the Fed actually cuts rates and what that means for the stock market and what it means when the yield curve starts to uninvert, right? Everyone's telling you about the inverted yield curve right now, but there's some important stuff we need to take a look at. So here on this chart, we're going to break down the Fed fund rate and the 10-year treasury yield. And you will be able to see that this is a really good sign of when the Fed is about to start cutting rates, right? We're also going to take a look at the 10-year, 2-year treasury yield curve. Okay, so we're going to take a look at the yield curve as well as the Fed funds rate. And this is another great indicator of when the Fed is going to start cutting rates. Then, of course, we're going to take a look at the yield curve along with the S&P 500. And we're going to show you guys, what happens when the yield curve uninverts. And that's what you really need to be prepared for and be cautious of. Okay. We're going to break that down, going and taking a look at the overall history of it. And then we'll go into some individual cycles here and individual time periods here, such as the .com and the '08 in, the financial crisis, as well as take a look at where we are right now. So that way you guys have a good understanding of how to prepare for the future. And, you're not caught by surprise and you're actually getting some good valuable information. And then we're really going to break down, I know everybody seems to know about what an inverted yield curve is, but the big thing right now is that the yield curve is uninverting because the longer term is going higher, right, and continuing to go higher, and we're not seeing so much of short-term treasuries go down, treasury yields go down. I'm going to break that down and let you guys know essentially what that means for the market and what that's actually telling you. Okay. Now, I do want to mention, if you guys are new to the channel, I started a completely free newsletter. It's called Investment Intelligence. And if you guys are fans of free, valuable finance content, you're really going to enjoy it. And I also try to sprinkle in some trade ideas. This was one on Tesla over a month ago. All right, going over some of the conditions that we were looking at, and that trade played out very nicely. All right, a lot of those conditions played out, especially if you trade options. It was a very nice trade. And you can also request a specific video now, okay, using Ko-Fi. So there's a link in the description for the newsletter to sign up for that, as well as a link in the description for Ko-Fi. All right, you can come in here and this is where you can request a video on the topic of your choice. All right, you can also come in here and now you can book the one-on-one personal sessions directly through Ko-Fi. You can book a 30-minute or 1-hour session. Again, you can do those through the commissions page, as well as if you ever enjoy the free valuable content I put out, you can come in here and click on the buy a coffee button, and it's basically a way to leave a tip or donation. Now, as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the disclaimer. And let's talk about right here in the beginning, what does an inverted yield curve suggest? Now, I'm sure all of you guys know this by now, but we need to talk about it. So an inverted yield curve is, basically viewed as an indicator of an economic recession coming. So what it means is that short-term interest rates are exceeding the long-term rates, all right? And this basically means that long-term outlook is poor and that yields offered by long-term fixed income will continue to fall. So that's what we've seen, right? And right now what we're seeing is the yield curve starting to uninvert. Now, an upward sloping yield curve, this means that the yield curve is uninverting. It's a natural extension of the higher risk associated with long maturity. So in a growing economy, investors also demand higher yields at the long end of the curve to compensate for the opportunity cost of investing in bonds versus other asset classes. So, you know, that's what we're seeing right now. All right, is we're seeing the yield curve, in an upward sloping direction, and it's because the bond market is demanding a higher yield for those longer term treasuries. Okay, and the reason that they do that is because they think that we're in a growing economy. Now, I know that there's lots of data out there, showing that we could be having a recession. There's a bunch of scary data and stuff out there, and I show that in my videos, but I also try to show, what the markets are telling us, right? And when you look at the job market, and we just got a crazy hot job market, NFP report, the previous market day before this recording. And, we basically saw twice as many job openings. Okay. And, it's very hard to have a recession when everyone has jobs, right? And when everyone can find a job. Now, they may not be the perfect job that you want, but at the end of the day, there's so many jobs available right now in our economy. And if that changes, then that's going to be a big factor. So, right now, long term, the bond market is what I keep trying to say. The bond market is not pricing in a recession anymore. Based on what we're seeing in the upward sloping in higher treasury yields. Okay, that's what we're seeing is we're seeing the yield curve start to uninvert, but it's because the longer investors are demanding more yield for the longer term treasury. And we're not seeing the shorter term treasury drops because the Fed fund rate, the Fed hasn't made it clear when they're going to officially pause and when they're officially going to start cutting rates, right? They're potentially still going to be continuing to raise the Fed fund rate at the moment. And, so there's not really a huge reason for, the short term treasury yields to start tanking. Right. Especially if the Fed does end up, raising rates one or maybe even two more times, then those necessarily aren't going to just start tanking. Right. Normally, that's when you see the yield curve uninverting is when, the short end of the curve, right? So the shorter term treasury yields, those start to go down, and then the longer term will stay a little bit higher and start to grow a little bit. But right now, what we're really just seeing is that we're just seeing the long-term treasury yields, the long maturities, those just continue to rise. And that happens in a growing economy. When they are bullish on the economy is when you're going to see these longer-term treasury yields continue to rise. So now that we've kind of got that out the way, we need to really pay attention to what it means when the yield curve uninverts. So on this graph, the red line is going to be the stock market. This is your S&P 500. And then in green here is going to be your yield curve. So whenever you see the ticks going down here, that's an inverted yield curve. And whenever you see it coming up, that's when it's uninverting. Okay. Now, when it goes up is when you tend to see the most pain in the stock market. Okay. If you look here, we see it start to uninvert. And in this time period, that's when we see the stock market dropping. Okay. And this is why I said that uninverting is usually bad for the stock market. The re-steepening of the curve and getting, back to uninversion normally isn't good for the stock market, right? You can see here as well, we start to uninvert, and now we're uninverted here. All right. And that's when we have all of this pain in the stock market. And what's really interesting is these are the shaded areas. These are recessions. Okay. All of these shaded areas here. And you can see that a recession usually comes right after the yield curve uninverts, right? It's right after the yield curve uninverts here, and we're getting very close to that. So if the yield curve is going to uninvert, sometime soon within the next year or so, it's very possible that a recession is going to be following, right? And that's the recession that everyone's speaking of. Okay. And if you take a look here, this is a basically right after the dot-com crash. All right. So, we're looking at 1998 to 2005. This is 2001 right here. And you can see right here, the yield curve is uninverting at this time period. And that's when the stock market peaks and the stock market drops throughout this time period here. Okay. And that's what people need to be cautious of if you're investing in the stock market is going to be the uninversion of the yield curve. That's something, that you want to pay attention to, and oftentimes has been, of course, the indicator of a future recession coming. And, you can see this more in the great financial crisis, right? In 2008. What do we see? The yield curve uninverting here, right? So now the yield curve is uninverted, and we see the re-steepening of the curve. We see, this, uninverting and steepening higher, and that's when we're seeing the stock market drop during this time period. So, when you look at where we are today, and you take a look, we had the, the inversion, and it's been inverting, and now we're starting to uninvert. And this is also when the stock market is starting to drop. So, if this thing really does uninvert, okay, and we start to see it looking like this, that could, spell potential future downside for the stock market as well as a recession. Now, it doesn't have to happen immediately. Okay, as you can see in these times, when the yield curve uninverts, and steepens, it continues to steepen a little bit before we see the peak in the stock market. Same thing over here, it uninverts, and then we start to see a bigger sell-off here after it's uninverted, and we see that continued steepening of the yield curve here. Now, when it comes to when is the Fed going to cut rates, if you take a look at the 10-year yield and the Fed fund rate, so the Fed fund rate is going to be in red, the 10-year in blue. You can see here that pretty much every time that the Fed fund rate is higher than the 10-year yield curve, that's typically when you start to see rates go down and rates start to cut, right? That's where we're at right now. If you look here, okay, the Fed fund rate gets above the 10-year yield, you see we start to pause, and then we start to get a cut. Same thing over here, right? We see that the Fed fund rate is above the 10-year treasury yield. That's when they pause, okay? And then shortly afterwards, they start to cut, okay? Same thing right here. We see this period where the red line is above the blue line. So the Fed fund rate is above the 10-year treasury. You see they pause, and then shortly afterwards, they start to cut. Same thing right here. Fed fund rate is up above the 10-year treasury. They pause and then start to cut shortly afterwards. Same thing here. Fed fund rate up above the 10-year treasury. It goes down. You see the Fed fund rate go down. Same thing over here, above, starts to go down. And each time that the Fed fund rate has been higher than the 10-year treasury yield, we've seen a cut in the Fed funds rate, right? Same thing over here, same thing over here, same thing over here, and same thing right here. And this is something that has been a really, really good signal. And to me, it's a good indicator that the Fed should be, maybe they won't, but they should be, at least fully pausing here, right? They keep talking about skipping rates and potentially, raising rates one or two more times. They may do that, but they're already above the 10-year treasury yield. Now, if the 10-year continues to rise at its rapid pace that it's been doing, it's very possible it catches up to the Fed fund rate. And maybe that's a reason why they're not committing to having to pause yet, is because, it may not stay above the 10-year treasury yield. But based on history and based on data, it seems that we're very close to getting, this pause and rate cut in the Fed funds rate, even though they keep saying higher for longer, higher for longer. We'll have to see how it plays out. But according to history, this is the time when you should start to be expecting some type of a rate cut in the future, right? Is every single time that the Fed fund rate is higher than the 10-year treasury yield. Now, this right here is another good way to tell when you're potentially going to see the Fed start to cut rates. And this is the yield curve. So we have the yield curve here in blue, the same yield curve we were looking at with the stock market, except this time we're going to be comparing it with the Fed's fund rate. Okay. And what I want you to see is that each time that the yield curve uninverts, right, it uninverted right here. And look what happened. That's when we start to get cuts in the rate. All right. We're very close at the moment to getting the yield curve uninverted. Okay. Again, you can see it right here when it uninverts, that's when they start to cut. Same thing right here. You can barely tell, but it barely went inverted right here, uninverted. And that's when we got the Fed fund rate to start to cut. Right here, you can see that the yield curve uninverts. That's when the Fed fund rate starts to cut. Same thing over here. All right, we start to see that, initially the initial point of the yield curve uninverting was right here, and that's when they started to cut. Now it did dip back down back into inverted again here, but initially that's when they when it first uninverted is when the Fed fund rate started to cut rates. Okay, and you can see the same thing over here, right? We're seeing, the yield curve uninvert at this moment here, and then we're seeing the Fed start to cut rates. And then we see the yield curve uninvert right here at this moment, and we see the Fed start to cut rates. So, these are some really good signs and signals. Now, they may not work in the future, but they've worked in the past. And so once you see that Fed fund rate above the 10-year treasury yield, which is that environment that we're in right now, it's very likely that we're going to be seeing, rate cuts in the future. Now, the big question is when. Well, this is something that helps you time it a little bit more, is when you take a look at the uninversion of the yield curve. So, we're in that environment now where we're not sure if the Fed is, going to continue raising or just leave them paused. But most likely, once we get that yield curve uninverted is when they're actually going to start cutting rates. Now, again, that's most likely based on the data that I'm showing you guys and just showing you guys what's happened in history. We'll have to see if that history is going to play out, if that pattern is going to play out like something similar it has here. But at the end of the day, all we can do is try to prepare for the future and try to prepare for how we want to have our portfolios positioned for different, economic situations and different environments in the markets. And, we're through that 2022 bear market, that interest rate bear market, that Fed fund rate bear market. And now we're heading into this environment now where there could be a recession coming. All right. We're seeing lots of indicators that there could be a recession coming. But right now, the yield curve is actually uninverting because it's seeing signs of a strong economy. So it's a little bit more confusing than some of the times in the past. So that's something that you want to consider and think about. But when it comes to potentially playing the bond market, It seems that we are getting very close to a bottom. All right. We probably haven't reached the bottom yet, but we'll see, if the Fed fund rate and if this yield curve uninverts, we'll see if that's going to lead to potential, Fed rate cuts. And I've dropped a lot of really good videos on TLT, on TMF, on EDV, on IEI, on many different bond ETFs and how they perform relative to the Fed effective funds rate. So basically meaning like when Fed fund rates are going up, when the Fed fund rate is going down, aka when they're cutting, how do certain bond ETFs perform and which ETFs perform the best during those environments? Those are all really good videos that you're going to want to watch. All right, so I highly recommend watching those and checking out the channel. Appreciate you making it this far. Smash the like button and subscribe for more.